Why does Fiverr, a company that just reported a double beat in its quarterly earnings, not see a significant boost in its stock value despite positive financials? Let's delve into the details without referencing the original speaker or source. Fiverr, a platform that witnessed a massive surge during the pandemic, has faced a significant downturn post-pandemic. The initial hypergrowth labeled it as a stock with immense potential. However, the subsequent decline in growth led to a substantial drop in its stock value. The recent quarters reflect a shift in focus towards profitability rather than hypergrowth, aligning with the challenging macroeconomic conditions. Currently trading at around 12 times forward PE, Fiverr seems reasonably priced, given its improved profitability. Despite the double beat in quarterly earnings, the stock's movement appears subdued. Investors who weathered the storm of a substantial decline might be questioning the potential for recovery. The CEO's comments, emphasizing strategic growth and shareholder value, signal a proactive approach. Fiverr seems to be positioning itself to capitalize on opportunities anticipated in 2024 when interest rates are expected to decrease. The focus on profitability amidst the current economic challenges showcases a determination to weather the storm and emerge stronger. As of now, the stock is down 1.3%, trading at $23.76, with a market cap just over $900 million. The forward PE is at 12.6 times, potentially undervalued considering the analyst estimates for fiscal 2024 and 2025 EPS. For long-term investors, especially those who have seen substantial losses, this might be a painful period. The key question arises, is Fiverr, with its vast addressable market, a no-brainer at its current valuation? The expansion of Fiverr's leadership team is a notable development. The addition of a new CMO and a board member with extensive experience in data science and machine learning suggests a strategic move to strengthen the company's foundations. Such additions can play a crucial role in driving innovation and adapting to evolving market demands. Looking at the financials, the third quarter results reveal a 12% YoY increase in revenue to $92.5 million. While active buyers have remained stable, spending per buyer has increased by 4% to $271. The impressive aspect is the improvement in market take rate, standing at 31.3%, indicating a positive trend in revenue generation. The gross margin has seen an increase, reaching 83.7% in GAAP and 85.2% in non-GAAP. The net income has witnessed a substantial rise, from $200,000 to $3 million. The announcement of strong Q4 and fiscal year 2023 outlook is a positive sign. Revenue growth is projected to be between 6% and 14% YoY for Q4, with adjusted EBITDA between $14.9 million to $16.9 million. The fiscal year 2023 expects revenue growth around 7%, with adjusted EBITDA ranging from $58 million to $60 million. While the guidance might be perceived as a bit weak by some, it could also be a strategic move to set a realistic baseline for future performance. Fiverr's focus on bringing high-quality buyers to the platform, stabilizing cohorts, and expanding its catalog with 50 new categories is aligning with a strategy to ensure sustainable growth. The addition of promoted gigs and Seller Plus programs contributing to an expanding take rate further reinforces this strategy. The introduction of Fiverr Neo, a cutting-edge matching tool, has received positive feedback, indicating a commitment to enhancing user experience. International market growth in countries like Germany, France, the Netherlands, and the United Kingdom is a promising development. Fiverr's ability to grow in non-English-speaking countries demonstrates its adaptability and appeal on a global scale. The flattening or decreasing year-over-year cost of revenue amid increasing revenue is a positive indicator of operational efficiency. While higher expenses may be necessary for future high growth, the current scenario paints a picture of a company becoming more profitable without substantially increasing its operating costs. The stock's roller coaster journey, from over $300 to the current $24, presents a challenging landscape for both long-term investors and traders. The decision to buy or sell might be influenced by individual perspectives on the company's future. The mention of potential further investment by the speaker, despite being heavily down on the stock, highlights a belief in the company's long-term potential. Fiverr's overall performance, strategic initiatives, and financial results indicate a company navigating challenges and adapting to ensure sustained growth. While the pain of existing shareholders is acknowledged, the long-term outlook seems positive for those who believe in the company's potential to capitalize on future opportunities. As for how this situation may affect the demand and pricing of Fiverr stock or general stock performance, it depends on various factors. If Fiverr successfully executes its strategic plans, the stock might see a positive trajectory. However, external market conditions, global economic factors, and competition dynamics can also influence its performance. Investors and analysts will closely monitor Fiverr's ability to deliver on its growth and profitability targets. Everyday Americans, what are your thoughts on Fiverr's current situation and future prospects? Leave your comments above. Disclaimer: the information provided is for educational and informational purposes only and should not be considered as financial advice. Investing in stocks involves risks, and individuals should conduct their own research or consult with a financial advisor before making investment decisions.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information. And it helps us spread the message. Sharing is caring.